Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be taking a look at Globe Life stock. There was a short report that came out yesterday on it. As you can see above, the stock was down over 53% yesterday. It's up maybe about 8% today off that bottom. And I had a request yesterday about this. I hadn't heard about it yet, so I went and checked it out, and I thought it was pretty timely, and so I'm going to make a video on it today. As always, this is not individual investment advice. This is just how I analyze stocks. And today I'm going to go through Globe Life to talk about a few things. I did track it already in my spreadsheet, although I never really followed it too closely because it never appeared to be like a particularly good buy. But I'm going to show a couple techniques that might have prevented an investor from buying it for paying too much for it, I think is how I would say it, before any of the short report came out. And then and I'll share some of my thoughts on a couple other things that they were doing that, you know, they weren't necessarily bad. I see companies kind of do it all the time, but as an investor, that would kind of turn me off to the stock a little bit. And then at the end, I'll comment on the short report itself and just kind of what I think about it. And I'll put a link to that report in the description as well. So, Globe Life, health insurance, or not health, maybe they are health. No, that's just the category. I think they're more life insurance, if I recall correctly. But an insurance company, if you look at their historical earnings, they're very steady going back for 20 years. So basically no cyclicality to those earnings at all. They had a flat year in 2021, which is probably to be expected with COVID. But generally speaking, earnings per share have risen over this entire time period. Now, what is interesting about these guys is that while earnings have been stable and steadily growing, if you go back to the 2008 recession, which I'll shrink this fast graph down, we can see that even though earnings were very steady, the stock price absolutely was not during that recession. So this is notable if you're trying to buy at low prices. So if we just put any of their individual issues aside, you want to pay attention to these types of stocks because it can be really easy to buy them too soon during a downturn. They can look super cheap because the stock price is falling and the earnings are staying steady. And even if you go back and look at their earnings history, it can be steady. But the market has a reason why they're selling off 75 or 80%. There's something about the business that scares the market particularly during recessions, and that's why it's selling off. Now, if it was just this one recession, we could maybe think, okay, that's odd, but sometimes the market just does weird things. But if we look back here to the COVID decline, it was falling at so much faster than the market, and at a similar rate probably that it was falling back in 2008. So if this 2020 recession would have carried on instead of being kind of propped up and bailed out by a lot of stimulus, it probably would have fell just as much again. The stock price would have, regardless of what the earnings were doing. So I call these types of businesses or stocks, they have deeply cyclical stock prices, even though earnings growth is steady. So there's like this disconnect. Now, generally speaking, I like these types of businesses because they can, if they're high enough quality, as long as they make it out of whatever recession is going on, you can often buy them really cheap and potentially make a lot of money on them. So if you would have bought down here and held until like up here, you would have had like 1,000, 1,100% return, right? So those returns can be really big if you do buy these really cheap in a downturn. There are some other stocks. Sometimes this one doesn't show up on fast graphs It seems to change the historical data sometimes for some reason. Yeah, so this time it's showing that earnings are dipping, but sometimes it doesn't. I'm trying to think of, sometimes it's like the financial, like maybe a T row might be a good example. Yeah, so if you look at their earnings declines back here in 2008, they were like 35%. So it's not like they were flat, right? They fell 35%. But if you look at the relative stock price decline, it fell more than double that, or about double that. So those are the type of real disconnects where the stock price is falling at twice the rate of earnings or more that don't quite match up. And there are a few more of these. I wish I could remember some more right off the top of my head, but I don't have them available. But you can make a lot of money if the business is solid. Now, with insurance companies, you never really know what their ultimate liabilities are. So I'm always pretty cautious, and I use history as my main guide. Like I would go back and say, okay, well, these guys did okay here. So I probably, one of the reasons why I track them is I probably would be willing to invest if they fell like 75%, right? So I might not buy after a decline like this, but just looking at my spreadsheet now, if they fell another 35%, short report aside, if it was just for some other reason, I would probably come in and buy, and hopefully I could maybe get one of these like 10xers or something, you know. But I don't want to buy too soon or to pay too much. And I know that without even really doing much research, you can tell that the market is going to treat the stock, probably going to treat the stock this way in the next recession. So, in probably the most relevant part of this is in January 2022, I went through my portfolio and I just sold all the stocks that I thought were like this. Like, maybe I wish I could. Let's look at principal and see how cyclical they were. Again, so they did have some cyclicality here, but not as much as the price, right? So a 90% drawdown on, let's look, on a, call it 30, again, like 35% earnings decline. So a triple, the stock price is falling triple what earnings are falling. And because there was more risk there, I mean, I think they might have even taken some money. Oh, I guess everybody was forced to take money at that point for the bailout. But yeah, that's the type of thing that I'm talking about, this disproportionate stock price decline relative to earnings. And you can also look at basic earnings too. Sometimes those can actually fluctuate more, but in these guys' case, they don't really, other than this little spike here. So that's the big picture. So I would if I did own this one, I probably would have sold it about right here. That's when I sold most of the other types of stocks that I had that were like this, that I thought even if earnings were okay, the stock price still could sell off very deeply. So I didn't want to experience that. So I sold them. I know Principal was one, T Rowe was one, Ameriprise Financial. There were a few more, but I can't think of them right off the top of my head that I sold this month, basically. Now let's get into some of the current valuation. So if I was going to do an earnings valuation, I think I started in 2014. And so one thing to note is this 2018 year was a tax cut year. There was like one-time corporate tax cuts. That's probably what explains this earnings growth. It actually mentioned something in the short report about the CEOs that came in 2017. I think this could be interpreted after reading that by some people as kind of juicing returns that year. I'm more inclined to believe this is due to tax cut related. So if you just exclude this which is what I'm going to do in my earnings growth estimates, and you look at how much they grew each year, earnings per share, you can look, it's like 6, 4, 7, 7, 10, 2, 0, 0, like up until 2022, they probably only averaged 5% EPS growth. But here's the thing, they bought back 30% of the company's stock during this time. So nearly 1/3 of the company they bought back. And that inflates these earnings per share numbers because when you buy back shares, the share number goes down, and the earnings per share therefore go up, right? Because there's fewer shares to make that calculation with. So earnings weren't really rising this fast at all. So after taking this big fast growth year out, I did include these two faster growth years, and doing the math on all this and then taking out the share buybacks, I got an earnings growth estimate of 5.32% over this time period, which is faster than inflation. It's okay, but it's not fast. It's not particularly attractive. And this brings me to maybe one of the bigger issues that I haven't talked about very much on this channel. And usually I don't deal with it until I get kind of down to the very end when I'm trying to make a decision on a stock or not, is does the capital allocation make sense? This is a business that's only growing 5 or 6%. Let's just call it 6% a year. Really growing earnings at 6% a year. And they're taking their excess earnings and buying back shares of a business that's only growing at 5 or 6% a year. Most of them, some of that money, they're paying a dividend out, right? So, but you can see the dividend hasn't really gone anywhere. It's barely risen each year. So really, my estimate is they bought back about 4 times as much stock as they paid out in dividends, 3 times to 4 times as much. And for a business that's only growing 5 or 6%, that is not what I want to see as an investor, because as business growth slows, especially when you consider 3% of that is inflation, so they're only growing like 2% real, 3% real. With a business that's growing that slow, it invites quite a bit of risk, because if earnings growth tips negative, then the stock price usually falls quite a bit. So what I want is, if a business is growing 5 or 6%, I probably, before I'm willing to buy something like that, I want like a 5% dividend. I think probably at least 70% of the earnings yield should be going out in the form of a dividend. So it should basically be reversed pretty much. They should have, if they did want to buy back a little bit of stock, they should have been paying out like 3 times or 4 times more than that, whatever that was, with a dividend. But the reason these guys don't do that is because, a lot of people don't. They'll look at the EPS and they won't go and look that it's mostly due to stock buybacks. So it makes everything look better on the surface for anybody that's looking to examine the business to maybe buy the shares or whatever. But the danger is when they buy back all the shares of the company, if something bad happens down the road, which it sort of isn't now or potentially is, instead of giving that money back to shareholders, like a shareholder could have had earned probably half their investment back if they bought shares 10 years ago by now. At least, maybe even more of that. It depends on how much they actually would have paid out. But so if something bad happens, like it loses 50%, well, at least you got 50% of your investment back, and you're not going to lose it all, right? And it doesn't have to be some dramatic event for that to happen. It can just be the business slowly declines. These are mature businesses. They're not growing much. If a new innovation comes along or competition gets tough, they can go away. Or if there's a disaster or something that happens, anything unusual. So when a business is really slow grower, I want that dividend as like an insurance policy, basically, that I'm going to at least get some of my money back if something bad happens. So that capital allocation thing, I think, is a big deal. Now, I control for it when I do the earnings growth. So that's one aspect of it that I already control for, but the actual decision of management to spend the money in that way, other very good investors have the complete opposite opinion when it comes to these type of buybacks for slow growing businesses than I do. So this is not like a hard rule of thumb, but this is a good reason why I think the way that I do, I guess. Okay, so let's see. I covered buybacks. I covered Oh yeah. So the way that you can try to gauge these deep price cyclical but steady earning businesses is with the recession PE that I sometimes use. So that's what would have kept me from buying this dip so far. I actually would expect the stock in a recession. This isn't a recession, but it's like a big price drop. I wouldn't buy it until it got down to $34 a share. So it's not even there yet, even after this big decline. Now, people laugh at me sometimes because if they would have looked at this a couple of days ago, it would have been like, oh, my buy price is 70% lower than where the price trades. And it's like, yeah, it was. But if you go back in time and you look, it can fall very deeply if there's a recession. And I want to be buying as close to the bottom of that as I reasonably can. I definitely don't want to be buying an experience like buy too soon and have like a 50% drawdown or whatever. So even a person that bought today or yesterday, this was at 29% before the stock rose today. Even if you bought there, if we did have a recession before the stock price recovered, you could experience still another 30 to 35% decline, and that would be normal. That's what happened in every other recession in the past two, basically. So the way that I calculate this is I take the, we can just use, I think I did 2020 for this one. You take the low stock price, which is $56.74. Take the high earnings going into that recession, which is $6.75. You create a PE out of that, okay? And then you would do the same thing during this decline. So you would use this as your peak earnings, assuming that this one's going to not come true. In a recession, it probably wouldn't. This is a different situation, so who knows. But you would take this low price and create a PE with this, and you would compare it to the one back here. And then usually, since this is kind of the most pessimistic type of PE situation, I add 40% to it, and then that's what I'm looking for to give. So I'm not trying to pick like the exact worst bottom. I just want to get close to it. So I have 283 as the kind of worst case PE. I'm not sure what it shows on the fast graph here. That might have been, well, that's not going to be the actual PE because it's going to use this. Let me see if it's 2008. I might have used 2008 instead of 2020. Yeah. So I probably used 2009 here as my example for this one. So yeah, so it was 283, and then I add 40% to it. So if this new recession PE gets to about 4, that's where this price comes from. It's the current price divided into peak earnings at 1065. So that's how to kind of keep yourself out of trouble. This one just happened to get lucky that it's behaving similarly that it would during a recession, basically. I had another one like this, Humana, which was kind of a different situation. But whenever things get bad, if you have your recession metrics already in place, which I happen to do, like in most conservative ones, basically, it can save you from a little bit of trouble. So that would be, now this is without judgment of any of the short report. This would be kind of the price that I would be looking to buy during a decline like this. Now, to the report itself. I'll put a link for this. I'm not going to go through the whole thing. You have to sign a waiver to read it or whatever, so I don't want to just put the whole thing out there. But I read through most of it. I didn't get into all the details just to get an idea of what was going on. Basically, pretty aggressive sales tactics by some of their I don't know if it was like a company they hired to do sales, but and then there's a number of allegations. You can go read them, but I thought in terms of short reports go, it was stronger than some that I've read. They're always like over the top to some degree. So a person's going to have to make their own judgment on that. I didn't think that they were totally outlandish accusations like I've seen from some short reports sometimes. So that's probably why the stock sold off. I think there's reason to believe there could be something behind it. I'll say this, like I get Globe Life's mail, like little mail advertisements or whatever that they send sometimes. I don't think they've changed in the past like 30 years or something from, in terms of like their marketing material. It seems strange to me. They're only growing 5%, right? So that seems normal for somebody that's using kind of just this old tried and true technique. I don't see their ads anywhere online, like Google ads and things. If you look at other insurance companies, they're kind of everywhere all the time. I don't get the feeling, Globe Life is like that. And so it seems to me like I wouldn't expect them to be growing faster, right? But if you look at this is all normal. Like I said, this is like a tax cut year. You can go all the way back in time, and they're growing like single digits basically all this time. I wouldn't be surprised if they were buying back shares all this time too. So, but then we get to the last 2 years and we have these giant jump. And so this is what makes me raise my eyebrows a little bit, because I haven't noticed anything that they've been doing particularly well on the marketing side, just personally, casually observing. But earnings have jumped 50% in 2 years. So yeah, I think that does raise, some eyebrows, and especially if there's incentives in place for salespeople to, use tactics to, hit numbers and hit goals and things. We know just from human experience that can cause people to go too far with those tactics. So it's just sad, but it's true. And so, yeah, I definitely would be suspicious of this earnings growth here on the back of the report. And I think it would probably be enough for me to just avoid the stock since I don't own it. I'll probably keep tracking it and put a note in there, and then we'll see how some of this shakes out. These insurance industries are heavily regulated, and I think most of it is on a state-by-state basis in the U.S., so it could probably be kind of hodgepodge. I don't know if that's good for a situation like this or not. Because it could mean you have like multiple issues in multiple states. It could get I would imagine it could get pretty costly, even though I think in the report they think people are going to go to jail or whatever for fraud and things. I don't know, man. It's hard to get white collar criminals in jail in this country. You have to take like $1 billion from somebody to get a couple years in jail, it seems like. But we'll see on that. But yeah, so for me, this would be an avoid. It doesn't seem to me to be a completely ridiculous report. And there's evidence here that there's a serious break-in trend with no particular reason that I can tell. And so, yeah, I think I wouldn't be a buyer here. I'll probably completely avoid this one. And if I miss out on a 100% return, I'm okay with that. Okay, hopefully that maybe gave you some tools that you can use to just kind of look at capital allocation and this price cyclicality. Those are a little bit more nuanced things that don't come up all the time, but they definitely come up enough to like where you'll want to pay attention to them. And the thing is, if they can keep you out of just a few marginally bad like purchases, it makes a pretty big difference in your portfolio. Like if you can avoid like these occasional 50% drawdowns, and then maybe put that money someplace that actually makes 50% instead, that starts to make a big difference in the portfolio. So around the edges, these type of things can matter, even though they're a little bit more complicated. All right, if you found this useful, hit the subscribe button. I also have a 25% off link for if you are interested in the Fast Graphs subscription. It's pretty useful. As you saw here, I was able to go back in time and look at those price and earnings patterns really easily. That's for new subscribers if you've never used Fast Graphs before. Just use that link in the description and the affiliate code. And I will see everybody later. Bye.